All right, what's up, everyone? This is Kirk here again at Option Alpha. So thank you so much for joining me again. This is, I think, episode number 20 that we've done here, but it's part two of our little mini series. This is going to be the only other part here on how I would start trading with a $3,000 account. We started this last time that we did an episode, just kind of walking through the idea, the concepts. Got about halfway through that. We got to basically expected value. We'll kind of cover a little bit of that. But then we're going to finish it out today with the other core concepts for our portfolio moving forward. So if we want to take a look here at the slides that we have, if you guys want to pull those up on the back end. So if you look at this slide and basically how I would do a $3,000 portfolio, it was essentially the first one that we went through. So we were going to go ahead and break down everything into building a $3,000 account. Again, we can't start with 5,000 just for the sake of argument. It's just a hypothetical, but I assume we would want to start with 5,000 if we could. But if you said and you forced my hand and said, hey, we only had to start with 3, how would I do it? And again, we went through, just as a reminder, this kind of portfolio curve here, just kind of looking at different profiles of cash and positions, etc. And so the building blocks essentially of this 3K portfolio was number one, ample cash and small position sizes. We went through that last time. Number two, market neutral, high probability trades. Ideally, iron condors with a 70% probability of profit or better. Again, we went through that last week. And the third thing that we went through was filtering trades for positive expected value and minimum volatility. And we kind of get through a lot of that, but I want to show you some more examples here in today's video so that we can kind of build on top of that. So let's quickly jump down to that area so that we can just talk about that. We went through this model of flipping a coin where originally the coin was just a regular coin where you'd flip it heads or tails. And then we got to these bent coin, possible scenarios, like imagining what if I took a coin and physically was strong enough to bend that coin and then I still flip the coin. What would those payouts in those scenarios be? And you start to see that, for example, in the third scenario here, where the coin is pretty well bent over, there's a 30% chance that it lands on heads because it would have to basically land kind of sideways, sitting on itself, and a 70% chance that it lands on tails. So using that, and even if I had adjusted the payout so that if you win $200, and if you lose $100, the net expected value of that potential game or that philosophy is that you lose $10 on average. Now, this is a hard concept to grasp initially, because initially when you're making trades, a lot of people are living through every single trade that they're making. They are emotionally attached to that trade. Is this a good trade? Is that a good trade? I lost on this trade. I must be doing something wrong. I won on this trade. I must be doing something right. All of that really doesn't matter in the granular minutia details of trading. What matters most is that the system that you're trading, or the metrics of what you're trading, your strategy, has a positive expected value. Because if it doesn't, no amount of lipstick can fix a pig trade, if you will. Okay. So we walked through that calculation, how you can kind of look at these different metrics and numbers inside of your account here at Option Alpha with the different expected values here. But what I actually want to do is I want to switch over and actually show you some live screenshots. Let me just switch my screen share in here, guys. And I want to show you this right here, which is a look at trade ideas right now as the market is kind of going, and you can see it's updated every single minute. Today, it's already run through 63 million trades in counting. And so again, what Trade Ideas does, and the way that we think about it, is gone are the days where you're going to go in and you're going to hunt and gather for trades the old-fashioned way, which is that you just pick a strike, pick an expiration, try to build a trade manually, and then you have to calculate everything out yourself, and you hope that you get it right. Those days are gone. Like, we can use technology and computers, AI, software to do this for us, this mass computation at an insane level every single minute of the day. And then what we do is we tell the system, hey, these are the trades that I want to surface to the top. So let me just reset everything here for a second. So right now, if I'm in Trade Ideas, I can come into Trade Ideas and say, I want a credit spread position I only want it in ETFs. So now I've taken this list of all potential trade ideas and I've said I only want ETFs now. So that just whittled the universe down potentially, down by like a third, right? It's like only or 2/3 of potential opportunities. Now I want ETFs. I want neutral positions because this is what we want as traders, right? We want trades that are neutral positions. And we want trades that have, let's say, 70% chance of success or higher. So right here, just by doing this, I've now taken all of the universe of trading opportunities and I have found the ones that have 70% chance of success or higher and are neutral strategies. Now I can take this even further and I can say, let's make trades that are minimum 20 days out from expiration. And let's make sure that the trades that we want have a positive expected value of $5 or more per contract per spread, basically. Now this universe is still pretty big, but now I have a universe of really good trades to look at. These are trades that you could potentially make in your brokerage account because now you know that these trades not only have a good probability of profit, kind of meet your criteria, but they also have positive expected value. They're also in ETFs. They're also 20 plus days from expiration. So you can hold on to these positions. You can build a portfolio of these positions as you go out. And so that's what we want to do as traders. We want to be able to find these trades a little bit faster than you could otherwise do it. And if you wanted to go in here even more, you could say, okay, I just want to look at only SPY, for example, of all this list. Okay, now of all the trading opportunities in SPY, and this is what I think is the coolest thing, of all the opportunities there are in SPY, these are the combinations of strikes and iron condors that make the most sense right now. Now, literally, if we come back to this in 10 minutes or 20 minutes, this combination might be vastly different. There might only be 2 opportunities here that meet your criteria. There might be 12 or 20, and they might go back down to 2 or 3. There's a huge opportunity here to find positions that meet your criteria by using this idea of shopping for a trade versus like the old archaic way of just picking and choosing strikes randomly. So now when I get into this, these are good looking trades. These are trades that have good risk rewards. They have good probabilities of profit, high positive expected values, right? These are trades we should be making as traders, especially as a new trader with a $3,000 account. We want to be making trades like this. So I wanted to show you that because I wanted you to see that we can find these positive expected value trades. And not only can we find them this way, just us kind of going through the process, but we can actually choose to then auto trade these expected values and put this into a bot, which I'll show you here as we keep going forward. Okay. So let me switch back over to the slides. Hopefully you guys are enjoying this, liking this. All right. So the next component, though, of our portfolio here that we're going to be building out is this line item that I put in here, which is that number 4, we need a basket of ETFs that are across uncorrelated sectors and industries. I think this is a really important one. I think a lot of people actually learned this lesson just recently when the market started to tank, right, at the beginning of this year. They started to learn the lesson that not all things, right, will go up forever. And so if you look at like the tech sector, which had a really, really tough start to the year, in most cases, it brought down a lot of stuff, but not everything. Not everything went straight down. Some stuff went up. Gold went up, for example, right? You saw bonds trading a little choppy and sideways. They didn't really go down as much, right, as the markets. But there's lots of opportunities here to reduce risk by trading a basket of uncorrelated ETFs. So what do I mean by this? Well, if you take this is the total risk of a portfolio, and you kind of graph this out on a chart by just number of stocks. Now, for the sake of argument, we're going to use this graph just to show a concept, which is the concept of having unsystematic risk as part of your portfolio and then having systematic risk or systemic risk. Now, there's a portion of your portfolio's risk that you have, which is unavoidable risk. This is risk that you cannot avoid. You can't diversify away from, you can't get away from it. That risk is systematic risk or systemic risk. And you want to think about it as the risk to the entire global system. That's the way I always remember it, because not always good at remembering things. So I remember systemic risk is the risk to the entire system or world. You could say it's the risk that an asteroid hits New York City. It's the risk that some countries go to war. It's the risk that so-and-so country leader, whatever, like gets removed from office. Like there's just things we can't see, and we can't hedge around those things. There's just risk. There's an embedded risk that you just can't get away from. That is systemic risk. The other type of risk that you see risk called unsystematic risk. Unsystematic risk is the risk associated with an individual company that you have, or an individual stock or ticker or ETF or anything that you trade. Because it's a lot easier to explain it using stocks and ETFs, I'm going to explain it using stocks. Let's say that you love Netflix and you fully invest everything into Netflix. It doesn't matter if it's options trading strategies, regular stock strategies, a combination. Let's just say all of your trading activity goes to Netflix. If you do that, you are, of course, invested in the broad market. You're now invested in a market that's anything that's risky towards systemic risk. I know that's a lot of risky names, but like now that you're invested, Netflix is, of course, subject to systemic risk. But in addition to that, it's subject to its own unsystematic risk. And that unsystematic risk is the risk associated with just Netflix itself as a company. So Netflix goes down. Netflix changes its pricing and loses a lot of customers. It can't create content as fast as it did before. It's like all of those risks are wrapped up in Netflix. So if you graph your total risk of your portfolio, you now have your systemic risk, your systematic risk across the entire global financial system. But you also layer on top of that, all of your risk is pinned on one single stock, one single entity. So if Netflix does well, you do well. If Netflix does bad, you do incredibly bad. It's all pinned on Netflix. Doesn't seem like a good idea, right? Of course not. So what we need to do is we need to diversify this out. Now, what a lot of people think of when they think of diversity is they just think add a lot of tickers, buy a lot of things. And while that I'm sure helps, the reality is that if you do just the mantra of buy a lot of stuff, you could find yourself in highly correlated industries that don't really add to your total portfolio for diversifying risk out. So for example, let's say we got into a position in Google as well. So we have a position in Netflix. Now we say, okay, I don't want just the position in Netflix because Kirk said it was too risky. I'm going to add Google to my mix. Well, if you add Google to your mix, you're not really diversifying your risk that much. I mean, you are, there's Netflix and Google, but they're two main tech giants, right? So adding Google to Netflix, yes, they're similar, but you know, they're different, but they're mostly similar. They're mostly going to trade probably close together. You can actually physically see this when you look at the S&P versus the NASDAQ. If you chart a graph of the S&P SPY versus the NASDAQ, their correlation is 0.86, which means that yes, the S&P 500 is different than the NASDAQ 100. There are different components to it. Some are the same components, but at the end of the day, they're going to trade very similar to one another. So if you buy 50% in SPY and 50% in QQQ, you trade 50% in SPY, 50% in QQQ, you're basically trading the same thing. There's no real benefit to doing that. So going back to our example, let's say now we introduce Microsoft. Okay, now you've got three. You're starting to slowly move down the total risk because you're not pinned on Netflix. But again, you've got this conglomerate of tech giants. You got Microsoft and cloud computing. You got Google, they got cloud computing. You got Netflix, that's software like cloud computing, streaming, like that's all basically the same. You still haven't done much to reduce your risk. So now what you do is you introduce what would be considered unsystematic or uncorrelated assets to your portfolio. So here might be an example. Add to your tech giants that you now have add Costco. And I'm not saying to do any of this, by the way, it's just an example. So please don't take this as the gospel of go out and buy Costco. I'm just using it as an example. But you take those tech giants and you say, okay, what could really add uncorrelated risk? Well, Costco might do that because people might buy groceries no matter what happens with their streaming service. They could cancel Netflix, they could cancel Microsoft, they may not use Google Cloud services or whatever, but they got to buy food. So they're going to go to Costco, right? And then maybe you add Starbucks because you're like, look, I know they got to buy food, but then I want to add like a discretionary coffee thing, right? And so now you add like a retail-ish play. And you take this a little bit further and you say, okay, well, now let me add a credit card service provider with MasterCard because everyone's going to use their card. So whether they use it here or there or whatever, they're going to use it. And let me add a bank like JP Morgan. So now what you've done is you've gone from all of your risk wrapped up in Netflix. What you've tried to do, and hopefully this is just an example, it's not a perfect way of doing it, but what you've tried to do is you've tried to allocate your capital across an uncorrelated basket of tickers, okay? And that's what we want to do as traders. We want to do this with ETFs. Gold in the dollar, gold in the markets is a good example where when the dollar goes up, gold is usually going down, right? Where it's kind of uncorrelated or negatively correlated. You want to get things that don't move and zig and zag completely opposite or completely together. You want to get things that kind of move not at the same, like if one moves, the other one doesn't have to move. And so that's our ultimate goal as traders, is to kind of build that portfolio out of uncorrelated asset classes. Now, the good news is we've kind of done the research already for you, and we have a list of tickers that you can use as a starting point. You can, of course, swap or change these if you want to, but we already did kind of the research for you, and so I'll show you what some of these tickers are. So first, as I do that, let me just kind of walk through the model now, kind of getting back to our example from before. Remember our capital chart or our kind of portfolio construction chart. So if we wanted to start this $3,000 model portfolio, the way that I would do it, the way I have done it with my real account, real money, and I'll show you that, is I've done 50% in cash. Now, we talked about that at the beginning, why it's so important to have 50% in cash, but just put 50% in cash. Even with a small account, just gives you a lot of peace of mind that you're not going to blow up your entire account. You've got enough money to keep the lights on, to keep trading, to keep going with this thing moving forward. Then what you're going to do is you're going to start breaking down the rest of the pieces of your pie into the smallest possible position you can. Now, I said at the very, very beginning, both days, the ideal portfolio is $5,000 to start with. If anybody ever asks me, how much money do I start trading options with? I tell them $5,000 is the bare minimum because the math works better at $5,000. At $5,000, you can actually get a position size that's less than 5%. Where the model gets broken, where we have to stretch it a little bit, is with the position sizing. The smallest position size that we could probably get for many trades that would make sense is about $200 to $250. So if I take the high end of that, you might be risking 8.3% in one particular ticker symbol. So you really want to get that symbol down lower if you can. If you can get into positions that are $100, great. $150, great. If they got to be 250, it's probably stretching it, but I'm going to use 250 in this model just to give us some wiggle room, okay? And then what you'll do is you'll take those positions and you'll get into a broad set of ticker symbols that are as uncorrelated as possible. So those ticker symbols would be things like, and I'll show you the rest of the list here in a second, but XSP, which is the S&P, it's also cash settled. So SPY is a good surrogate for this if you want to, but XSP is cash settled. You have EEM, which is emerging markets. You have TLT, which is bonds, XRT, which is retail, GLD, which is gold, and XLU, which is utilities. So right there, you can see in those 6 tickers that we have, we've got a pretty diversified set of things that we're trading, such that if bonds blew up, hopefully they didn't take gold and utilities with them. If retail blew up, maybe emerging markets stayed true and gold and utilities were okay. If the S&P blows up, maybe emerging markets and gold are okay, but bonds do okay and retail goes down, but utilities go up. Like that's what you're after. You're after something that doesn't all go down together with the ship. You want to, as a small account with $3,000, spread your capital intelligently across lots of different ticker symbols. All right, so let's see this in practice here. We'll switch over to my slides here. And here is the portfolio that I built out for this. This is actually the second version of this portfolio, because the first version that we had was with TD Ameritrade, which subsequently got bought and then stopped. So I started up a new one that we have going, and that portfolio is trading live. This is a live trading portfolio. I started this thing back in August or September of 2023. So it's been going now for about a year and a half. It also has been going through this market downturn that we've had, and it's handled it pretty well. So I wouldn't say that it's perfect, but it's a good working model of what you can do if you take the exact requirement or like framework that I just put together here and you put it into a bot. Now, if you look at just some of the metrics here, total return is pretty good so far on a starting capital of $3,000. So when I started, I said, look, you've got $3,000. If you blow it, you blow it. Right now, the portfolio is worth about $3,800. Clearly, you're not going to quit your job on $3,000 of starting capital, but it's proof of concept that you can start trading with a small amount and do really well and not have over 50% of your account allocated, right? So this is actually very, very good for new traders. If you look at stats here for like capital allocation, you can see that for the most part, we stayed right at or just under that 50% allocation the entire time. A couple times we had positions that were just a little bit larger than our allocation at the original start, but as the portfolio grew, it's allowing it to grow into slightly larger positions. But from the onset, we've never had 75, 100% of the account allocated. We just haven't. So we've had around 50% or under. I'd say the average is about 30, 35% allocation. So this is like a really important concept, which is that you can grow an options trading account by not trading all of the capital. Look, options are a leverage product. Like leverage is very dangerous if you don't use it correctly, and you can blow yourself up. But I think if you use it intelligently with like a grain of caution, right, you can do well without trading your whole account and leveraging just a small component of that. But that cash allocation is very important because we could have needed to use it at some point, right, as we went through it. Win rate has stayed pretty high. Win rate on this bot right now is about 85%. The drawdown that we went through at any point was about 15%. So, of course, you're not going to be immune to drawdowns. Totally a manageable drawdown. Even something 20, 25% seems manageable for a leverage strategy. The thing that I look at are things like this, which is profit factor is very important to me. I look at profit factor after many trades, because after many trades, it starts to get an idea of asking yourself or answering the question, if I put $1 in, am I expected to get $1 out? And in this case, if I put $1 into this trading system right now, I should expect to get $1.59 out of it. Now, it doesn't mean it's always going to happen that way, because that profit factor moves as we win and lose positions. But that means that I should, on average, expect to win some money on a trade. And you can see, on average, the win is $30. Or sorry, the average P&L on a single contract that we trade is about $10, which is good. Our wins that we've had is about 84. Our losses are about 14. My biggest losing streak was 2 losses in a row. That's important too, because we're trading at a high probability. We don't want to have consistent losers, though we're going to have them, but that's the goal with high probability, is to remove the consistent loss streak in favor of going for smaller, more consistent wins, which has generally worked out. So that's kind of the overall. If we go into the settings of this bot, you can see this bot is using that watch list of, and I call it the list of about 10 tickers that are as uncorrelated as possible. And what it does is it goes through every single minute that it's going to go through a scan and start finding positions. And it runs through this list of symbols, and then it ranks them by implied volatility rank. Now, I talked about this earlier in this presentation, where I said, look, I'm going to go through a list of symbols, but whatever symbols have the highest implied volatility rank, I'm going to take those first. A couple of weeks ago, it was gold. Before that, it was XOP. Then it was XSP. Right now, it's XRT, XLP, and XLU, which means those are the ones I'm going to grab first if I have an opportunity to get new positions. Now, again, the flexibility using this within a bot is that this is always updating. So whatever is the highest implied volatility rank, that gets sorted and added first to your bots, and you try to get into positions. Now, inside the actual automations themselves, what I've done is I've essentially set up this bot to run through an automation that looks for opportunities. So here's how this automation works. I set my automation to run every single minute. Now, it doesn't mean it's going to make a trade every minute. It just means it's always on during the day. The first thing it's doing is it's pulling in those bot symbols. So it's looping through those bot symbols. In our case, it's checking to see which ones are the highest implied volatility rank, and then pulling that list into an action called open a trade idea. Now, here's where you can just define all of your details just like we defined them when we manually looked for an opportunity. So remember over here on this tab, remember we went to trade ideas and we said, hey, we want an ETF, neutral, 20 days or more, probability of profit 70% or more, right? Here, we are defining that. When you go into an automation, you simply define that inside of an action called open a trade idea. It's going to tell you what symbol you want, what expiration you want, right? Those are all pulled in from that information. Like we told it the symbol because we put in the bot symbols. We told it the expiration because that's an input for the bot. Just we want 20 to 40 days. And then from here, we leave the strikes optional. So I don't care what the actual strikes are because I don't care if it's the 62, 63. I don't care if it's the 14, the 19. I don't care. What I care about is that the trade fits my parameters. It makes sense for what I want to do, not only probability-wise, but also expected value-wise. Then down here, we tell it the position size, which I'll show you here in a second. We tell the bot how to price the strategy, and then we preset our exit options. So we just basically tell the bot, look, this is how you would exit a position if you want to. But in the entry criteria, this is where it gets really fun. This is like just a checklist. The thing I always use as an analogy here is like when you order food online or you go to a restaurant, you'll tell them I want a hamburger and I want lettuce and tomato and no pickles, no bacon, but I want cheese. Like that's what you're doing here inside of Trade Ideas. You're just telling the bot what your order type is, like what the things are that meet your criteria. So number one, the bot has to have enough capital. Don't send an order if the bot doesn't have enough capital. The bot has less than one position with this symbol. This is really important because this forces the bot to only get into one position per symbol. So if I can only get into one position per symbol, I've effectively capped the risk at what I know the risk is going to be for that one particular symbol. So that means I'm not going to get into multiple positions. I just want to diversify across one position per symbol. I do a low-level IV rank filter. I say it's got to be 20 to 100, assuming it's going to be high, but that doesn't mean it's always going to be high. We could be in a broadly low volatility environment. And then I do some other position criteria, like I make sure the bid-ask spread is pretty tight. I make sure that there's no positions that expire before an ex-dividend date. That removes the risk of assignment for positions early. I check and make sure that the alpha is greater than 5, that the expected value per contract is greater than $5. Again, these are bare bone minimum requirements. So they got to be better than this, which means I'm not going to take a trade for sure that has no expected value or negative expected value. Not going to happen. I have a bare bones minimum requirement of $5 per trade. Now, if you set that higher, you just might not get into many trades or any trades if you set it too high. So you got to be careful with that one. I set my risk reward greater than 50% and my probability of profit greater than 70%. Again, these are very important because we want to make sure we're getting into not only high probability trades, but trades that pay out enough money and have a positive expected value. You can just set this criteria in here and let the bot do the work of looking through the positions for you, right? And then the last thing I do here is I set my max loss per contract at some value. Now you can set this lower if you want to. If you want to start and you say, I want it to be $200, you can set it lower and it'll look for tighter positions. Now that my portfolio has grown a little bit, I set it just slightly higher than $250 and I set it up to $300. That's because I know that I'm going to be collecting some premium. I know the numbers and the math on this. So I'm starting to slowly edge my portfolio higher. But if you're just getting started, you can set this to say $200 or $150. That is how you control risk right there. You do one contract of position size, and then you control risk right there. And then we, of course, always rank our ideas by alpha, which is the best way to rank it, and we're good to go. So that's it. Literally, our automation is pull in a bunch of symbols, find the one that meets my criteria, and then enter that trade. And that's what it's doing. And so right now, it's got 4 positions on, one in XLU, one in XBI, one in EEM, and one in GLD. It would have more positions on if the other tickers met the requirements. But in many cases, not all symbols are going to meet the requirements at all the same times, or it might have entered a position and needs to space some positions out. This is what I wanted to do. It's just very simple, but over time, this is what it's been doing. It's been doing okay, doing this process over time moving forward, okay? So that's what we kind of want with this. If we go into the inputs for this automation, like I said, are these values here. These are just ways that we can quickly change them, but I told the bot 30 to 45 days, one contract, and open around or within 4 cents from the mid price. I have exit options set for taking profits at 30%, or if the position is 1 day from expiration. So essentially within this, I've completely wrapped up management for this bot. I'm going to take profits early. That's part of my system, is to get into high probability trades, take profits early, which is why my P&L per trade or per contract is low. But I'm doing that on purpose to recycle capital faster and reset my probabilities, so I'm not taking a huge amount of risk, because I don't want lots and lots of losing trades. I want to create a high frequency, low P&L trade count that just builds over time. And so I moved up my profit taking to 30% here. But I also have an exit option for expiring if it's 1 day before expiration. So essentially, that is how the bot is built out. We'll have a link to this, hopefully in the show notes when these guys put this together, but it's inside the community. You can clone this template if you want to, and use this moving forward, okay? So that's really what we want to do. So now remember, the whole idea with all of this, just to get back to the slides for a second here, the whole idea with all of this is to build this portfolio out, right? This is the model portfolio. You got to use all of these frameworks that we did, a basket of ETFs across uncorrelated sectors, take profits early to build consistently and increase the win rate. I do a 30% target. And the reason that we do all this is so that you can live long enough to build a high trade count. That's really the end goal here. If we can get to a high trade count where these numbers really start to solidify, that makes it a lot easier, right? That's what we want. We want to get to a point where we're doing 200, 300, 400 trades over time. And that's how you survive in this market, okay? So I hope you guys really enjoyed this, kind of going through this here today. This was, I hope, a really good part 2 and kind of capstone on this. So we went through a lot of stuff in part 1, but again, part 2 here was kind of rubber meets the road, where we're actually showing you how to, what that portfolio might look like, how you might use it with bots and automations. The whole idea here is to remove yourself from the equation, build a system, let a bot run it, automate it. That's how you build scale and consistency in your trading. So until next time, happy trading.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.